I'm Jenny Brown. Welcome to this week's Buy-to-Let Mortgage Market Update. I hope everybody is doing really well. We've got lots of good things to cover off with you this week. A bit of movement in the holiday let mortgage market space, some pricing coming out for green mortgages as well to cover off, and then some general repricing and criteria changes to run through with you as well. So another busy week from the lenders. Also this week, I just want to talk to you a bit more about open banking, what it is, how it can help improve the mortgage application process. We've referred to open banking in previous weeks, and some people have emailed me saying, can you just explain actually what this means? So we're going to go into that in a little bit more detail. The reason it's relevant is really how the world's going to go going forward, so you may as well find out about it up front and be at the forefront of knowledge in terms of this. So holiday let mortgages, the Cumberland have reduced pricing on some of their rates for larger loans, so loans over £750,000. So their pricing starts from 3.74%. Now, Cumberland are able to lend on holiday lets to people, limited companies and LLPs. They don't necessarily have a minimum income requirement. I say necessarily because they have standard products and non-standard products. So for no minimum income requirement, that's a non-standard product. To be eligible for their standard product, you'd need to have £20,000 a year. They can accept portfolio landlords. They can accept properties with occupancy restrictions. Now, what that means in kind of the layman's terms is if you were buying a property and under the title there was a restriction which said this property can only be rented out for 46 weeks of the year, or conversely, this property can only be lived in by the owner of the property by, say, 10 weeks per year. So something that restricts how you use the property. And actually, for holiday let properties which are in really kind of, I guess, obvious traditional holiday let locations, so for example the Lake District, Devon, Cornwall, particularly in their more coastal towns, these restrictions are not uncommon. So it's great that the Cumberland can accept those, because a lot of lenders wouldn't. They're also fine with lending under their non-standard product range to people who are not homeowners, and they work on, when looking at affordability, the actual holiday letting income or projected holiday letting income, rather than working on a notional AST rental figure, which some of the other lenders do. So look, the holiday letting market is still doing incredibly well. There's lots of landlords who are looking to invest in these. So we are seeing more movement in that market in terms of pricing and criteria, and lenders looking to come into that space as well. So it's a growth market, both in terms of lender offering and also investor movement. So great to see Cumberland making some improvements to their range there. Lambay have released 14 new green mortgage products, which are aimed to incentivise and reward energy efficient rental properties. Now, what they're saying is that these products are suitable for standard properties, non-portfolio loans to landlords with 3 or less buy-to-lets, small HMOs, so HMOs of up to 6 rooms, and multi-unit freehold blocks, so essentially properties on a single title where there are 6 self-contained units. And these need to have been registered with Land Registry at least 2 years ago. And have to have an EPC rating of C or above. So what they're essentially doing here is looking to offer more competitive pricing to those properties which are not, brand new builds, because we would expect those properties to have a really high EPC rating as a matter of course, but really rewarding those people who have taken a property which is at least 2 years old and have, essentially improved it and really brought the energy efficiency up to a standard which ultimately it's going to need to be in a few years anyway. The rates are good. They start from 3.09%. They're available to individuals and limited companies. And I'll talk more broadly about the Lambay criteria in a moment, because they have also made some rate reductions on their larger HMO and multi-unit freehold block offering, with rates now starting from 3.69%, which for the properties they accept, so they're larger HMOs and multi-units, these are for properties with 6 to 12 bedrooms or self-contained units. So the pricing actually in that space is very good. Now, in terms of Lambay criteria, so to access any of these products that I've just mentioned, you need to be earning £25,000 a year. This can be comprised of standard earned income, self-employed income, so salaries, which are share of retained net profits. It can be rental profit, it can be pension income, so lots of different sources. It's always very interesting we talk about the minimum income requirement that lenders have. In the more sort of specialist end of the market, lenders are very comfortable accepting things like rental income as your income, but the more high street style institutions, so for example your Santanders, they really want you to have £25,000 a year income that's not from property, so in addition to your rental profit. So look, so to borrow with Lambay, £25,000 a year can be from rent. You can be aged up to 79 at the point of application. I don't mind how many properties you've got in the background. They can accept load companies, and they do day one remortgages. And there's lots of other great things sitting within their criteria as well. So really good to see yet another lender really pioneering the green mortgage space. The Mortgage Works has reduced some of their 5-year fixed rate remortgage products, which means their pricing in that particular space is incredibly good. So the Mortgage Works rates on 2-year money start from 1.19%, and the 5-year rates are now starting from 1.64%. So incredibly good. Now these rates are available, like I say, for remortgages. The Mortgage Works have rates for people who are also purchasing, I should hasten to add. And these are for individual borrowers. They do have a separate product set for limited company borrowing, which is also, the pricing on those is also very good. Now, in terms of the Mortgage Works offering, so they are able to, on these very low products, accept borrowers with up to 10 properties. They do have a separate product set for those people with larger portfolios, so more than 10, which again, in that particular, space is very, very good, well priced. In terms of maximum ages with the Mortgage Works, so look, if you are an experienced landlord and you are borrowing less than 65% loan to value, there are no restrictions on age whatsoever. If you don't meet that criteria, then you can be no older than age 70 at the point of application, but you can still have a 35-year term, which I think should cover most of us anyway. Now look, there is no minimum income requirement, and they are able to accept let to buy applications, which we are seeing a huge number of at the moment, where people are looking to break chains in this frenzied housing house purchase market that we find ourselves in amid the stamp duty holiday. So a let to buy is the process of where you would keep your existing home, put it on a buy to let, and then buy a new home to live in. So the let to buy mortgage, the let to buy process is the putting of a buy to let mortgage onto your current home. Now lots of lenders offer these. They're not a special product as such. Either lender does accept this kind of process or they do not. And there are other lenders that do these, but like I say, they are incredibly popular at the moment for those people who are looking to break chains. Other criteria from the Mortgage Works, which is quite nichey, they're very good at unusual construction types. So by that I don't mean flats above takeaways. What I do mean is things like unusual construction types, particularly where you've got an element of timber frame, some sort of concrete panelling system potentially, and also eco homes they're very, very good at. The Mortgage Works are a lender who have very good service. The reason they have good service is that it's very much an automated process system. So essentially it's computer decisioning, which, obviously makes things a lot quicker than if you're having to pay someone, and use a person's time to review an application. So what we tend to find with the Mortgage Works is either you fit or you don't fit. There's no kind of greyness. You can rarely kind of appeal if you don't fit, for example, credit scoring criteria. But look, if you're ticking all the right boxes, the products are incredibly good. And like I said, their service is really, really fast at the moment as well. Capital Home Loans have made some reductions to their pricing, and their rates are now starting from 2.99%. Now, Capital Home Loans are a relatively new lender. I say they're a new lender. They were lending pre-credit crisis and they went away for like 13 years or something, and they've just come back. So newish. Their criteria is definitely more that of a specialist lender than a high street lender. So they're looking for lending to limited companies and individuals. They have an offering for HMOs of up to 6 rooms, multi-unit blocks of up to 6 units. They can do day one remortgages. They don't mind how many properties you've got in the background. They will stress test the portfolio, working on a rental calculation of 125% coverage, assuming a notional rate of 5.5%, which is pretty standard, to be honest with you. They can accept first-time landlords. They can do day one remortgages. Yeah, and the offering is very, very solid. I think it's fair to say that, you know, and we mentioned this when Capital Home Loans launched, their offering is good in that space. I think that they've got lots of time to kind of start moving things on once they start getting their lending really underway. But in terms of the pricing, with rates starting from 2.99%, they're actually playing incredibly competitively now. WestOne have released some new products which are incredibly competitively priced. They've brought out a limited company rate at 75% loan to value, and the pricing there is now from 3.14%. They've also brought out a new limited edition product for small HMOs and multi-units, where the pricing now starts from 3.59%. They've also made rate reductions across their range. Now, in terms of the WestOne offering, I feel like they're kind of slightly going further than some of the other specialist lenders in terms of what they will and will not do. And I'll tell you the criteria and you'll see what I mean. So there's no maximum age limit, there's no minimum income requirement, there's no maximum properties in the background. They are very happy to lend on flats over commercial. If it's food outlets or anything that's kind of noisy or open late, it's 65% loan to value. Other than that, they're in the game for 75% loan to value. Minimum size on studio flats is 30 square metres, which is, you know, quite generous. Minimum term of a lease would be 55 years at the end of the mortgage term. So essentially, that means the minimum lease term at application would be 60 years. So they're very good at things like ex-local authority flats, things with deck access. So, you know, really playing in the specialist end of the market, but on the kinds of properties that some of the other lenders maybe wouldn't be that keen to take on. Available to individuals and limited companies as well. So it's really great that WestOne have really brought their pricing down to really align themselves with the rest of the market, but meanwhile having some really kind of niche criteria. Virgin Money have made some reductions to their pricing of up to 24 basis points in the last week. Now, Virgin are very, very good lender who lend to individuals only, so no limited company structures for these guys. They're also not looking for HMOs or multi-units or any of that kind of stuff. But they do have some really good criteria. So first of all, you can be age up to 78 years old at the point of application. They do need you to earn £25,000 a year. This cannot be made up of rental income. It has to be from, traditional employed income or salary and dividend, share of retained net profit, whatever it is, but it cannot be derived from rental. Now, they are able to top slice on applications. This is where if the rental calculation is not quite working out for you in terms of obtaining the level of borrowing that you're looking for, but you have lots of disposable personal income knocking around in the background, they are able to bring this into the mix and uses to essentially try and make up the balance and get the loan amount that you're looking for. They can lend to you as long as you have no more than 10 mortgaged buy-to-let properties in the background. They are going to stress that background portfolio using a rental calculation of 135% coverage, assuming a notional interest rate of 5%, which again in the market is actually probably on the more generous end, if I'm honest with you. They are able to accept remortgages against full market value at day one, as long as you've done some works to the property and can demonstrate why you've seen an uplift in valuation so quickly. And they are able to do let to buy applications as well. So really, really solid offering from Virgin with some incredibly good rates. Now that's it for our lender news this week. But as promised, I just want to talk to you a bit more about open banking. It's a phrase which is relatively new and you may not necessarily have come across it before, but more and more lenders are pioneering the use of open banking as part of their underwriting process. So you'd be forgiven for not really knowing what it is, how it works and what it means for you and actually what the benefits are of using open banking. So I really wanted to talk to you in a bit more detail about this. So first of all, essentially, what is open banking? So open banking is where you open up your bank account to a lender's computer system so they can talk to each other. And the lender can essentially access your bank account to have a look at the transactions that are going through your account as part to help with their underwriting process. Now, in terms of what this means for you and how it works logistically. So with the lenders that we use who use open banking, when we make the mortgage application, the lender will then contact you directly asking for your permission to access your bank accounts, and using various communications, a link will be set up where you directly grant the lender access to your bank account. So it's not something we can do on your behalf, you have to grant permission. Now, once the lender has access to the bank account, what they're able to do is have a look at it and see the kinds of transactions that are going on. So how much money is coming in, how much money is going out, how much money you have sat as balances, that kind of stuff. Now, the reason this is really beneficial to you as a borrower, actually, in terms of the mortgage application process, is it negates, first of all, the need to provide bank statements, because the lenders can go into your bank account and quite clearly see income coming in. They can cross-reference it to mortgage payments going out and do the kind of due diligence that lenders like to do when they're underwriting mortgage applications. So the first thing is that it reduces the amount of paperwork that you need to provide. Also, the use of open banking helps with what's called KYC, so knowing your clients, so essentially money laundering requirements. By doing these checks, it helps the lender on that side of things as well. Now, also what it does for lenders is it really kind of, it speeds up. I mean, the term that gets used and is very popular at the moment is makes things frictionless. So the less paperwork the lender's having to ask for, the less times they're not needing to come back and ask questions, the quicker the application becomes, which means that things really move forward very, very quickly and at pace. So there's really the benefits of this. So it's all about kind of, improving the process and making things nice and as pain-free as possible. But obviously opening your bank account up to a third party is quite a nerve-wracking prospect as well. So some of the concerns that people have is really about security, the kind of information the lenders are looking for when they're looking at your banking information, and also how long they're able to access that information for and what they can do with it. So what I would say here is that the lenders are purely accessing the banking information to be able to do the underwriting for the mortgage. They are genuinely not interested in how much you spent at Sainsbury's last week. They're really, really not. It's all about doing their due diligence as part of their application, in the same way that if they looked at your bank statements, they would have access to the same information. So I can assure you they're not doing it to kind of be, nosy or something. When you grant access to the lender to the open banking system, first of all, there is a shelf life for how long they have access for. I think it generally sits at around 3 months, but at any time you can go in and retract that access. So once the application, for example, is completed, you can go into your account and pull the access away from the lender because they simply aren't going to need it again going forward. So you do control that. Now, in terms of security, actually, people would argue that this is far more secure than sending documents around. So the information that you provide is literally an access link. You're not emailing, bank statements across. There's no chance of interception. So in terms of security, one could argue that actually this is far more secure. And the lenders actually who use open banking really are sort of really pioneering the fact that this is the most secure way of letting lenders access your banking information. So I think really in the round, what we can deduce from this is that open banking is really the pioneering use of technology as part of an underwriting process. It is more secure than sending things across on email, or if we really want to be old school, in the post. It allows things to move forward much more quickly. It's very secure, and actually you can control how long the lender has access to your accounts as well. So really, really good. And like I say, we're seeing more lenders, particularly those newer lenders who are coming in with new systems, are really kind of using open banking as part of their underwriting going forward. And this is really an area that's just going to grow and really help improve things from the borrower in terms of your experience of applying for a mortgage. I hope you found that useful. Another busy week in the world of mortgages. It's relentless, isn't it? For those of you who are looking to get a transaction completed before the end of the month with the stamp, or the first of the stamp duty holiday deadlines, good luck. I know we're finding things to be fairly high octane at the moment. We are doing all we can to try and expedite as many of those cases as possible. If you do have any questions, please do give us a call, 0345 345 6788, or go on our website, mortgagesforbusiness.co.uk. There's lots of information on there, case studies, mortgage calculators, all that kind of stuff. But look after yourselves. I will be catching you again this time next week with lots more news. Thanks so much for joining us.